Welcome to Proper Wealth with me, Paul Mahoney. This is the show where we discuss all things wealth creation, including property. Joining me today is Daniel Owen-Parr from Together, and we're going to be discussing bridging finance. Welcome, Daniel.
Welcome.
So perhaps we can start with what bridging finance is. We'll start fairly simple and build up from there. So bridging finance as a product or an offering, what is it?
So bridging finance, or what we call it is short-term finance, can just be a very short-term loan secured against property for a number of different uses. It's normally very quickly set up, and it's normally very flexible in what the client is looking for.
Okay, right. So generally looking at either someone who needs the money really quickly, or for more flexible means. Is that fair to say?
It sort of sits in, there's regulated and there's unregulated bridging.
Okay.
So just to give you a real simple understanding of that, anything that's regulated means that either the client lives in it, they're going to live in it, or it's more than 40% of their home.
Yeah.
So if we secure it against that, then it's a regulated one. If it's unregulated, that means then it could be just like an investment property, commercial property, something along those lines.
So somewhat similar to a standard mortgage.
Yes, exactly.
Whether it's related to where they live or whether it's a commercial activity.
Yeah, it's exactly the same as doing a normal commercial loan, but it's normally the speed or it's the flexibility that the client is looking for compared to a standard mortgage process that they would go through.
Okay, right. And how long have bridging loans been available?
Oh, bridging finance has been out there for years. Right. And if you go back historically, it was probably seen as the lender of last resort. So it was, rather than going to your high street bank, if you couldn't get one there, you would go and get a bridging loan.
Yep.
And that's really evolved over the last sort of 10 years now.
Okay.
For the more savvy investor, it's probably the lender of first resort now because of that speed.
Okay, so in the past it was more of a fallback.
Yes.
An expensive fallback, I assume.
Yeah.
But now people are actually using it for its speed.
Yes.
Even though perhaps I assume it does cost them a bit more than your traditional finance options.
Yeah, if you think about if you went to your high street bank,
Yep.
what you'd pay your high street bank for a long-term facility, they don't really equate. A short-term facility would be interest paid each month, or it'd be rolled up, but it'd be a monthly charge for it. But if you think the average one probably lasts about 7 months, what you entirely pay is relatively small compared to a long-term facility with a bank. But if you compare like for like, yes, it is more expensive.
Okay, and I suppose that depends on what the person's going to use the money for, doesn't it?
Yeah.
Rather than sitting around waiting months to get a mortgage or to get development finance, they might be able to get into an opportunity to make more money over those months by using bridging finance. Is that fair to say?
Very, very much so. It's the opportunity cost.
And why do you think there's been that shift? You mentioned about it being a fallback initially. Now it's something that more savvy investors are using for its speed. Why do you think that changed?
I think it's two main points on that. I think firstly, after the financial crisis 2008, 2009, the main financial institutions, which were the go-to place for anybody for looking for finance, have retrenched slightly on their credit policies. So what they offer clients now isn't the same as what was there 2008.
Yeah.
So when there's a correction in the marketplace and they've left some of the traditional parts of finance they were looking at, alternative finance, short-term finance providers have come and filled that gap.
Okay.
And I think secondly is around an education piece. I think it's known in the industry more now, so it wasn't just some small backstreet lender as such anymore. The large brokerages will offer this. People come directly to financial institutions. Okay. So it's really, especially through auction markets or through programs like yourself, we talk about it a lot more now.
Yep.
So the education piece, people understand that. So I think the two main points on that.
There definitely does seem to be a boost in that side of the market so far as the short-term lending goes, and it's quite interesting. Obviously the big high street lenders pulling back and tightening their criteria. Obviously that does leave a gap.
Yeah.
And it seems, as you say, the bridging lenders are kind of moving into that gap. And I suppose because the rates are higher and because it's short-term, the risk is slightly less to the lenders as well, not just the borrowers.
And I think that's one of the misconceptions sometimes about bridging or short-term finances. It's a light touch, and that's just not the case. It's exactly the same as you would go through for a normal mortgage. They do all of that there, but their processes, what they will look for is just slightly different to allow that to go through quicker.
I suppose there's a focus on it being quick, isn't there? Because that's the offering.
And it's that nimble approach. So you can have a scenario where you can speak to a client in the morning, you can have the offer letter out, you can have the legals instructed all on the same day. Now, I'm not sure many high street banks are able to offer that to the clients, so that's where they'll play a premium. But as it has grown, more people have come into the market, so there's more competition. So one thing that has happened over the last 5 to 10 years is the average sort of cost of a facility has dropped.
Right.
There's many people in the market now. So sort of, you've got your 10 major providers will do 75% of the market, but you will see in the financial press on a regular occurrence another bridging lender that's coming into the market because there is just that appetite for it.
And approximately what is the cost I'm assuming there's a range depending on the project and the opportunity, but approximately what can somebody expect to pay for bridging finance?
Well, it's all around risk. So the first part of it, if it's a residential property, it's going to be much lower. Right. So if you're either doing a residential regulated bridge, or if you're even just doing like a buy-to-let type bridge where you're getting a regular 2 up, 2 down, or a 3-bedroom semi, you would look to pay the lower end of the market. So you've seen rates from 0.49 all the way up to maybe 0.85, and that's sort of a rough gauge on that. Commercial will probably start around 0.75 all the way up to, depending on the asset class and where it is in the UK, maybe 1.25, and then you have development finance that can start anywhere from 0.85, which I've seen in the market, all the way up to 1.5. Once again, it depends on the risk, it depends on the client, and it depends on the exit strategy. The big thing with bridging is that most bridging lenders will look, what is the exit strategy? They're happy to lend the money and secure it as any other financial loan would be done. But they're really looking on the exit strategy. How are they going to be repaid?
And all of those rates are per month, aren't they?
Yes, they are. And you'd normally get it in a way as that some bridging lenders will ask for interest to be paid each month. Some will roll it up at the end, and some may deduct it from the original advance and keep that on account. So
there's various different ways in which it can be paid for, or the cost can be accrued. Okay, that makes sense. What sort of criteria does a lender look at to determine what that risk is and whether the lender is a viable, whether the borrower is worth lending to?
Yeah, in most cases, it's what I've covered before, previously. So they look at the asset itself. So they look at it, if you look at it as a residential, then there's less risk because there's a bigger market for it. So if the worst were to happen, they're able then to dispose of that either through an auction or through estate agents, something like those. So they normally look at slightly cheaper rates on that one, and they find it much easier to underwrite because there's a lot more comparables. But they will also look at the individual themselves, so it's their capability and their character to make those payments or make the exit in the end. So if it's something like...
things like experience?
So
if they've done it before, and does that all come into account?
That really does come into the account, because if it's something like a development loan, then most lenders will be looking at their ability to actually physically do what they say they're going to do. So, for instance, if they've done a conversion before and then they want to build 10 properties, there's a massive difference in what they're looking to do, so you'd be a little bit more wary. You'll do the normal checks as any lender would do lending anybody money, so it's know your customer, it would do maybe a credit check on them, so it's that type of stuff. But it's very, very simple for a bridging lender to say that is the asset, and then they normally lend against loan to value. And the LTV or loan to value there is normally relatively conservative. So you'll see something like a residential property going up to maybe 75% loan to value, but you'll probably averagely maybe 50, 60%.
All right. So generally you want the borrower to have a fair bit of skin in the game?
Yes, very much so. You want between 20, 30% in there on a residential, maybe slightly more on a commercial property. And then when they've got that investment in it, the likelihood of things going wrong are very unlikely then.
Of course, they're obviously going to want it to work, aren't they?
Yeah, of course they are. And normally we do, especially residential, it's very difficult to get things wrong. If you buy a good price to start off with, you add value to it and then you put it back in the market. Different regions have slightly different issues, but in the whole, you'd normally, if you can buy good at the start and get it at a good rate, you should have no problems.
Well, that's all we've got time for now, but join us after the break for more discussions on wealth creation, including property. Welcome back to Proper Wealth with me, Paul Mahoney. Joining me today is Daniel Owen-Parr from Together, and we're talking about bridging finance. So Daniel, before the break, we spoke about bridging finance, what it was, the evolution of the product and the offering, why people are using it, and some of the benefits to that as well as the costs. So I think we've covered that relatively well for anybody who wasn't fully familiar with the offering, which is great. What I'd like to talk about now is some examples or some case studies on where people have used it for various different reasons, and I suppose what they've got from it.
Yeah.
So could we, perhaps if we start talking about, you mentioned the residential property option is one option.
Yes.
Can you give me an example of where someone has used it for that purpose?
Yeah, so bridging is a very flexible way of finance. So one of the ways that people use it is in the auction market, for instance. And in the auction market, you normally have 28 days to complete.
Right.
And it's imperative it's completed in that short period of time. So a standard mortgage can be quite difficult to achieve within that period of time. And the vast majority of property that's sold in there is residential property, so it's your very standard 2 up, 2 downs, or your 3-bedroom semis, something along those lines. Yeah. So where we get a lot of people contacting us is around that speed there. So they'll come to us and they'll say, before an auction, can you give me a decision in principle? So I can go to the auction with real confidence to understand.
And that decision in principle, that is just for an amount, I assume, or is it actually specific to a property they're planning to bid on?
So this is normally the property they bid on. Okay. So they will come to us and say, for instance, they'll give us an auction name. There's probably over 300 auctions in this country that sell property at any stage. They'll come and say, lot number 17, for instance, and then it'll have a guide price on there. And that guide price is what the auctioneer puts on to say, this is where we expect it minimum to go for there. We would always say to the client, what are you willing to pay for it? Because normally they'll be paying more than the guide price.
Okay.
So if they come to us and say, I'm willing to pay 150,000 on that one there, we would then underwrite it on the back of that to say, we'll do our own checks. We'll be happy to say, yes, we would lend against that for you, and that could be done in a matter of 10 minutes. And we'll do a very brief credit check on somebody, and then they'll be all sorted. So they can go to the auction with confidence. They can bid up to 150,000. If it goes higher than that, then we still maybe be able to support them, but they would come back, and if they want to carry on with that, we may not be able to go up to the full amount they were looking for, but we comfortably do 70% of what they're willing to pay for it. Okay,
so they go to the auction with a bit of confidence as to what they can bid, and knowing that there's a very good chance they'll be able to get finance within the time frame they need.
Yeah, and it's really, really important because after the 28 days, they're normally given around 10 days grace, but they could be charged interest. And after that 10 days, they can be sued for deficit of sale. Right. So basically, if they put it back into the next auction and they've sold it for 150, but it only goes for 120, the client can be sued for the 30,000 difference. So it's the
it's
trust.
Not just a deposit; it's actually what it's if it were to sell for less.
Yeah. So it is imperative. What
if it sells for more?
Not had that too many often, but no, I doubt that anything would happen in that case.
Right.
On that. But we'd get people on the day. So we can attend an auction, and they'll have somebody in the auction room there that would be able to give them that decision in principle, or after the fact, where you will have somebody that is paid slightly more for it, or they believe they're going to get finance from an institution that then falls through. You would have people then looking at, can I get, and that's where bridging lending would come into it there. So.
And I suppose with auctions, often there's something wrong with the property, isn't there? That's quite often why it goes to an auction in the first place. Is that fair to say?
It can be one of the reasons. There's a number of reasons for the reason to go to auction. Yeah. It could be that it could be disposed of by another financial institution, so where somebody has not kept to the mortgage payments, they want to then deposit that property and get rid of it. So that could be one reason why it could be somebody who's gone through the normal estate agent route and not been able to secure a property. They need to move relatively quickly. Yeah. So a scenario could be moving abroad. Yeah. So they'll put it into an auction pretty much knowing that they're going to get a sale in most cases on that. So there's a number of different reasons why, but yes, it could be in there.
I suppose my point there, so far as there being something wrong with the property, that might mean that traditional finance might not be available at all. Is that fair to say? So they may not be able to get a buy-to-let mortgage because, for example, it doesn't have a kitchen.
Yeah, a kitchen and bathroom is one of the main reasons why a high street lender wouldn't lend on that. Where for any property developer or investor, however sophisticated they are, to put a kitchen and bathroom is relatively cheap in there. So we're quite happy to lend on that.
So the bridging would allow them to get the property, it would give them the time to fit the kitchen, and then they could exit using a traditional buy-to-let mortgage, for example.
It could be simple as painting the property, or it could be adding an extension on, changing the roof, doing a number of different things. It could even be getting rid of Japanese knotweed. It could be anything along those lines. Bridging finance would allow somebody to get that property. They can do whatever they need to do, however small or large, and then they can move out onto a standard facility.
Okay. So, for example, they buy a property at auction that doesn't have a kitchen, the example we used, and they get it for 20% below market value.
Yeah.
The bridging might cost them 10%, let's say. They've made 10%. Obviously, that they get the property, so they've got the speed of getting it, and they've actually made some money as well. So it's obviously beneficial.
Very beneficial. So that's one of the main reasons what we come across people is that speed side.
Yeah, okay. And that's to actually go to an auction and buy a property.
Yeah.
Is there any other uses for bridging, or what are the other main uses?
Well, one of them could be for business, for actually getting some capital quickly.
Okay.
So you'll come across scenarios where individuals may have their own property, or they may have a commercial premises they trade out of, and they're really looking for that speed. They may approach their bank, and it could take them 3 months to get that money. In a lot of cases in business, it's all about that opportunity to get things quickly. So they may turn to bridging to turn around and say, I'll use the equity in my own home or the equity in my commercial property, and I'm able then to take advantage of that opportunity. So it could be something as simple as buying from abroad and having a contract to sell into a UK distributor, for instance, or one of the supermarkets, but they just need that capital very, very quickly. It could be maybe exiting a partner from a business and being able to pay them off quickly, or it could just be expansion, buying more raw materials for whatever their industry is.
I suppose that makes sense, doesn't it? Because even though the rates with bridging might be higher than with residential mortgages, for example, I assume they're probably not all that dissimilar to business lending rates. They're probably there or thereabouts the same. So if that's an easier way of them getting the money and a quicker way of them getting the money, then that probably makes sense.
And it is about the speed. That's the main thing in that market. It's really about the speed, taking advantage of opportunities, but also in looking at the opportunity in their own, maybe their residential property. They may have quite a large residential property of their own with a very small mortgage on it, and they're able to then use that money to reinvest back into the business. So we do see that quite often.
Okay, and I suppose the exit there would be cash flow of the business, would it, generally?
Yeah, very much so. So normally you would see a contract in place, or you'd see some accountants would give you a projection of how the business is going to repay that. Once again, these facilities are normally only last for sort of 12, 24 months at the very most.
And does, from a lender's perspective, when looking at that type of bridging, is it very similar to the residential side in that you're looking at the property and the financial position of the borrower, or does the actual business come into play as well, so far as whether the business is profitable?
Most important, obviously, is the property.
Okay.
So you're looking at that loan to value to keep that within comfortable parameters. The next part of it is the individual and their capability to pay back. And that's normally shown through business performance, past, present and future, so with projections. I mean, normally a bridging lender would get in touch with the accountant, or the accountant would provide a reference to show that. So normally you'd see a set of accounts and then commentary from an accountant just to confirm that they do have that capability to make those payments. Okay,
that makes sense. So great, we've covered two very different uses of funds there with bridging. Is there anything else with regards to what's changing or where the market's going, I suppose, is what we haven't covered? Where do you see the future of bridging going?
I'd say bridging is growing. If you look back 2013, you probably do, as an industry, probably 3 billion. This year, maybe up to around 6 billion. 2020, you can see 8 billion. So it's growing industry. And like any industry at the moment in time, digital innovations coming into the market. So you see peer-to-peer lenders, you see traditional lenders going down a more digital approach where people can get decision on principles online within 10 minutes. So they can sit at home at 8 o'clock at night and they can get a decision in principle rather than waiting for the traditional business hours between 9 to 5. So the progression of that further and further down the line, and then every part of the process they can add digital opportunities in there. So with solicitors and conveyancing, so that's one way to speed that up. So it's all client driven about that speed and that decision making process.
So different types of lenders entering the market, tech becoming a big part of it, and the offering to the client, making it easier for them to do the things that are usually a bit painful.
Yes.
Okay, great. Well, thanks very much for your time, Daniel. That's all we've got time for now. Thanks for watching, but join us next time for more information on wealth creation, including property.